What we wanted to do is make this very interactive. And the reason for that is I know Alex and I both know many of you across the room. Many of you have already engaged with many of the topics we're speaking about very extensively. Some of you have pioneered some of these instruments. Some of you are getting involved now as businesses. And so we don't want to make this just another session. We want to make this more technical where possible. We want to make this more interactive. So we want to spend at least the last 20 minutes on questions and answers so we can really dive into some of these themes. And what I want to do is start by just running through a few slides and a few concepts. Spend about 10 minutes or so on that. And then ask Alex to come up as well and share some similar thoughts. And then right after that, spend time on Q&A. But before any of that, just for our benefit, so we can make this really useful, I want to do some brief shows of hands just to understand who's in the room beyond those that I know. So just the first set, we've done it before, but very helpful. Who among you are businesses? So you run or work with solar businesses that are interested in raising capital. Just raise your hands if you wouldn't mind. Great. So it looks like maybe about 50%. And who of you are on the capital side? So just looking to deploy capital, whether equity or debt. Great, 25% or so. And then development partners, those that are looking to catalyze, put in grants, etc. A few. Perfect. And then last question, separate topic. Those of you both on the business side and the investor side, when you think of the areas in which you have most questions when it relates to the capital stack, raise your hands if you have more questions on debt than on equity. More questions, concerns, you want to spend more time on that ideally. And vice versa, on equity instead of debt. And okay, mixed, which is good. I don't want to gloss over some of these topics. So first few of the slides I think are just more theoretical in terms of how this all fits together. And then we did allocate more time in terms of some of the different specific instruments. I know when you're looking to finance businesses, and especially pay-go businesses, it can get quite complex. And we've heard a lot of conversation recently around special purpose vehicles, around off-balance sheet financing. And we want to spend time diving a little bit more into some of those instruments and the trade-offs between them as well, because I think that, at least my understanding, is some of the key area of interest. So let me start things off, and we've got a clicker here somewhere as well. With just one slide that's fairly, I think, intuitive, but I think useful to present as well, which is just how this all fits together, at least within the solar home system space and solar more broadly. Which is there is a growth curve, and we've seen that growth curve over, I believe, since 2010 now, where there are early innovators, there are early products, and they typically receive financing, at least theoretically, from seed, friends and family, angel investors. What's been interesting in this space is that's also come from grants. And I think most of the major players, I can safely say, have also received forms of catalytic capital because what they were doing is so innovative and new. And so I think just looking at this curve, that early innovator slide has been a mix of grants, but also seed equity, and then through the different stages of equity, series A, B, and C, leading up to more growth stage. And really what we're seeing now is that several of the pay-go players, for example, are already in what I guess I would define as growth stage. As I'll get to in the next slide, that's defined a little bit differently for this industry than others. Often growth stage is associated with profit, as well as it is rapid revenue growth. But because of many features and dynamics of this business model that I think most of us are familiar with, that hasn't always been true here. And that's created an interesting dynamic for financiers, and that's one thing I'm going to try and address, and hopefully Alex as well. But what we've seen is that growth curve continue through growth where we're not just looking at equity anymore, we're also looking at various debt instruments. And we've seen a transition there to debt instruments that are initially unsecured because the security is poorly understood. So when you're collateralizing using receivables for consumers who are at the base of the pyramid or based in more remote countries, you face different challenges around assessing that portfolio health, and using that collateral becomes more challenging than, for example, a mortgage or an auto loan, which is why you see the emergence of some of that unsecured, higher cost capital on the balance sheet, followed by then a shift towards more secured debt, cheaper debt, more commercial debt, and then, as we'll get to in other slides, potentially even off sources of securitized or off-balance sheet financing. Not to be controversial, but when we speak to commercial investors who are looking at commercial debt, their opinion that we've heard is that no players exist currently in the solar home system space in Africa who they would define as mature. I think most of us would agree to that, but that curve is really, I think, where some of the larger operators are seeking to get, because you do realize the lowest cost of capital, the most scalable sources of capital. You're not raising $5 to $10 million, you're raising $50 to $100 million. We've seen some raises reach those levels and increasingly do so, but the commercial lenders are only just starting to emerge in this space. And I think as we look to serve millions and tens of millions of households, the overall financing need that we're speaking about, I think I can safely say, is in the billions of dollars, not the tens of millions of dollars. And that involves that segment of the capital markets that hasn't been accessed much. So let me flip, and this is another way that we've looked at this across. I think this is meant to be true for a broader audience in terms of what does this actually mean more specifically across these different financing structures. And the reason we've mapped it to an EBITDA curve is actually a result of work we did with DFID over a year ago now, speaking with many of you around the room. And really what we were seeing is when businesses are going out to investors in the market, especially more bank investors, they're coming back and saying, great, tell me about your cash flows. And it's not just how many units you've sold, it's not just the revenue you've achieved, but tell me about your cash flows. And when the answer is, well, we still don't have positive EBITDA, we're still seeing negative cash flow, that makes complete sense from an operational perspective because you're investing in growth. You're investing in overhead and R&D to actually develop products and get more to the market. You're investing in new expansion markets. I think that's probably true of most of the businesses here. But what that does mean is that you're not necessarily seeing the returns from a cash flow cycle, especially if you're a pay-go business, which is providing consumer finance over, say, a 2 to 3 year horizon, well, 12 months to 36 months. And so what you're seeing is there is a mapping that we've seen, at least ourselves, to be true across that spectrum, where starting from equity-style instruments when there really is negative EBITDA and also earlier stage results across a track record, and very high cost of capital, right, and no leverage in that capital structure, moving across to that period where you're starting to access debt, but it's high-cost debt, and at which point you're also starting to advance slowly towards more closer to positive cash flow. And then finally to a point where you're just on the verge of EBITDA positive / already demonstrating positive EBITDA, and that's, I think, where it's safe to say some players in the industry are just getting to that point, at least among the pay-go space, which is really where you're accessing more secure debt and initial securitizations. Now, you might still be EBITDA negative, and there might still be lenders, as there have been, who flock to the table with hundreds of millions of dollars to finance that. But that really isn't tapping into the broader capital markets yet. That's just on the verge of that. That's at that sort of impact investment horizon where lenders themselves are taking a bet on coming into businesses who, in traditional definitions, might not be viewed as investment ready for that form of instrument. But these businesses that have made really good use in creative ways of the assets they have. And this is really, I think, one of the most exciting stories of the pay-go space. You have significant assets in the actual inventory you're holding when you purchase it from the factories, when it comes in stock before you sell it, and then in the receivables that emerge after you actually make the sale and you're holding onto the receivable for the full credit period. And so these are substantial assets that would otherwise sit on the balance sheet of the solar company, which we're using in these cases for different creative financing mechanisms to enable more growth, to enable more sales, more expansion. And then to this level that arguably hasn't really been shown, at least in the pay-go space in Africa, which is this proven EBITDA level, where you are realizing increased leverage, you're reducing your cost of capital, you're increasing your leverage, and I say optimal because we could get very deep into discussion around how to assess different levels for these covenants. But ultimately, you are getting to a point where you are using capital efficiently. You're no longer raising very large amounts of equity and diluting shareholding, but you're able to use what equity you have for other core functions of the business, be it new market expansion, be it R&D, and all these other innovative functions. And I think that sort of curve down on the bottom, that arrow, is really where most businesses we've spoken with hope to get to in terms of reducing cost of capital and getting to a point where you're using more capital more efficiently. So I wanted to present it this way to link the instruments also, because I know that I would expect many of your questions and much of the discussion will focus on trade-offs. It's not just that debt and equity is available, but what's available in between? What different structures of debt are out there? How do I choose between the different instruments, and when do I choose? And many of those questions I want to go into during Q&A, so we can really tailor them a bit more. But I wanted to sort of sketch the different landscape here as a starting point. getting a little bit more detailed on debt. And again, happy to speak about equity, but I did want to spend a little bit more time on some of the topics you've mentioned are most interesting to you. And just go through a few different products that we've seen be particularly prominent in the PAYGO and broader solar space. And just what I'm going to do is spend a little bit of time just talking through a little bit of practicality around the terms I have up here instead of just reading the slide. And then I'd love to invite Alex up as well to share a bit more from the investor side of having evaluated investments using these different products and seeing the result there. But as I said before, we're looking at different forms of debt, and frankly, we personally over the past 5 years have probably seen 30 to 40 different shades, if you want to call it that, of debt. Different instruments that have different nuances around terms, be it where they want to sit from a collateralization perspective, how much collateral they think is necessary, how you structure yield versus collateral, which is sort of a critical risk-reward equation for lenders, tenors, different convertibility and warrant structures. We've seen 20, 30 shades, so I don't want to come here and assume that these three buckets represent all debt available in the market. But what I do want to emphasize is this industry has attracted more innovative financing structures than we've seen in, I think it's safe to say, any other industry in Africa, maybe save for MFIs in the early days, though that industry has matured pretty significantly. And so just talking through some of these, early on, and this, about 5 years ago when we engaged several of you in the room, some of the PAYGO and solar companies, when the model really wasn't proven and this consumer finance model really wasn't shown for assets on the solar side, we did see initial lenders that came in and said, well, look, you don't have collateral that I understand yet. You've sold 100, 200 units. You don't have meaningful on-balance sheet collateral, but I'll still extend you a loan because your model fundamentally is on lending in a sense. You're offering leases, often the structure is, to consumers, and I'm going to help you finance that. But I need some sort of upside to warrant that. So either I'm a soft lender and I don't need upside, or I need upside that is in the form of a very high interest rate, or some sort of upside structure or warrant or equity. And that's really where we saw this category. And there, the key questions were really, how do you balance the high cost of capital? Because if you are at this stage and you're asking for loans when you would otherwise be asking for equity, you then need to give to investors a much higher return to warrant the commercial trade-off between risk and return. And that's really where we see that line. And then moving to the sort of secured instruments, and this can be a range of different instruments. It's looking at, what are the assets on the balance sheet of these companies and how can we help finance them? So it's looking at the inventory you have, financing the period through which you make the order, typically to a firm overseas, often China. You place an order, you wait for that order to be manufactured, you wait for the order to be shipped not just to the continent, but then inland, and that several month period, financing that so that you can bear the cash flow before you actually make a sale. And that inventory financing has been critical. That can in some cases be replaced by trade finance, letters of credit from banks, supplier terms. These are very common in the space as well. But then leading on and fit, I think, along the line, if you will, with receivables finance, where you've taken your inventory, you've translated it to receivables, and now you're looking to finance that. We've seen several models for this. We can get into the on and off balance sheet equations of this. You're either taking an on balance sheet facility where your receivables remain on balance sheet, but they become the source of collateral, or you simply buy the receivable into more of an SPV type structure that I think has been one of the hot topics and phrases of the event so far. But either way, you're looking at fundamentally what is the collateral, what is my security, and if I'm buying a receivable, how likely is that receivable to default? And as a result, how much comfort, how much of a buffer do I need on the receivable to warrant that risk exposure? Or can I just take a typical debenture here in Africa, an all asset cover against the business's other assets, which are in fact largely receivable driven in the first place, and can that protect me? Or in some cases, and we can get to this later as well, as banks for the first time, local banks look at entering the sector, can I structure a more traditional banking instrument like an overdraft facility that provides access through an account to local currency financing, which is, I know for many people, the holy grail of what we're trying to accomplish to minimize risk. And then ultimately it's off-balance sheet segment. And just very briefly here, there are many shapes and forms of this. Many of you in the room have pioneered this. I know Lendables here, Sunfunder as well, several others that have really tried to craft instruments. Dirk at Persistent Energy Capital. But fundamentally, you're looking at how do I purchase the receivable book to make it risk remote from the operator of the actual assets. I take the receivables into a separate vehicle And then that operator continues to service, to collect receivables, to service the customers in the field, but all the risk remains mine as the investor. And if that instrument truly works, which is more of a typical securitization structure that we might see in developed capital markets, you're presenting a form of capital to businesses that makes their business model more scalable, arguably, than any other. Because from a risk perspective, you've now removed that consumer finance risk, which is why I think it's brought so much conversation so far. And there, features like advance rates are critical. How much am I going to get in loans versus the actual collateral that I'm selling to the off-grid facility? So if I have a 50% advance rate, for example, then I am getting a loan of 50% of the value of the receivables book that I am shifting to the SPV, where the residual balance might come back to me at the end of the day, but that is collateral that is held by the investor to secure the portfolio. So what I wanted to do is we do have one more slide after this that shares a little bit more of the structure of that instrument, but I wanted to stick to sort of the 10 minutes or so and invite Alex to come up as well and share his thoughts also from the investor perspective around these terms. And then, as promised, we only want to spend a little bit of time on that before shifting to Q&A, so we can really dive into some of the concrete examples that are most interest to all of you. So, wow.
Hello. All right. Great. Yeah. Good afternoon, Just. So yeah, I mean, Andreas has covered quite a lot. Just reflecting on who raised their hands before, it was a bit of mix between equity and debt. So we sort of skipped over the equity component just to mention it's not specifically listed here. It's more of a, let's say, a hybrid type structure that's implied here, but. Also, these are sort of listed as common terms, and I think everyone who's at least looked at these types of financing options is probably pretty familiar, at least at the concept level, with these types of financing instruments. I think from a lender's perspective, look, we're familiar from the Western markets with utilizing these and applying these types of tools. It's a question of how do they apply to the business models in the markets that we're looking at. Only a few of these are, let's say, simple, potentially low-cost instruments that we can execute from a lender and operator standpoint that won't take a year to transact on and won't cost $200,000 in legal fees, which no one really wants except for the lawyers, I suppose. But I mean, it's a real... these are all, many of these are, other than, let's say, convertible notes, for instance, and perhaps a type of an unsecured loan, are fairly complex instruments that take a lot of time to work through to understand the underlying collateral. Early stage equity investors often use convertible notes that are priced at the next round because it's simple. They don't have to value the company at that stage. They can execute fairly seamlessly, and it's a fairly simple transaction with low legal costs, given what typical sizes of investments are. So I think it's a balancing act that we're all trying to complete here when we look at the typical size of the ticket, so the needed investment size, what we'll be deploying, the cost of the transaction, and the applicability of the instrument. So, just to mention that, I mean, it's listed here that these are common debt products, and they are, but not necessarily in our markets. So there's a lot of learning going on that we've seen as investors and participants in the space, which has been great over the last year or so. But how do we get to lighter, more seamless, standardized transactions is one thing that's important, I think, for both parties and for sure from a lender perspective. We look at which of these apply. Just to walk through a bit, I can't quite see here too well, but in the case of unsecured and secured loans, a lot of the work we've been doing as lenders is to understand the underlying collateral, and it's not universally applicable across operators. So also segmentation and ability to offer loans over certain tenors or periods of time. So the front end of the business cycle, from point of manufacturing to point of sale, for instance, is of course a shorter term loan with fairly understandable inventory that can be valued closer to cost of goods for that period. Post-sale, of course, is the receivables financing, which we've all been talking about, which is typically a much longer tenor, depending on the product and the pay-as-you-go model, but typically can be 2 or 3 years. This is a long tenor. This is a complex credit risk analysis to understand the underlying collateral, and it may be that the business, the lender, and a third party need to spend considerable amount of time to understand what that value should be and what the advance rate could be. So as lenders, we spent a fair amount of time over the last year or two trying to understand how we sort of systematize these and use common methodologies to apply to collateralization rates, to advance rates, and that are universally applicable across the different operators in the space who are doing similar work, but in different ways and in different markets. So that's just, I guess, an initial sort of lender's view. As you know, we've worked with 4 or 5 of the operators here in East Africa and also in India and elsewhere, and we see very common issues. One thing to mention is, grants are not mentioned here. They've come up in the last 2 days of discussion, but DFI support and grant support in understanding the standardization of these products and legal fees in some cases or other due diligence related activities that are value add additional to the transaction are really important. And we try to partner with folks as much as we can on these points, and I think it's very valuable for the operators as well as the lenders. So look, I mean, Andreas covered quite a bit. I'm hesitant to say, because I recognize quite a few faces here, if we should jump into Q&A or if it would be worthwhile walking through any specific aspects. But these are the key points, and frankly, if there are quite a few questions, I'm inclined to open up the floor, because it's been a very active dialogue over the last 2 days, and I think most people here are probably pretty familiar with the topics that we're discussing, and that might be a more effective way
Great. So
to open up the conversation.
Oh, sorry. Do we have any initial questions then for Alex and Andreas? Everyone's being a bit shy. Any hands in the room? Yes.
Yes, my name is Dieter Poortman. I'm from TCX. I have a question. In your experience, Andreas, in dealing with potential lenders into this business, I refer to one of your first slides where you are mentioning the EBITDA. Of course, there are reasons to look at the EBITDA, but there are also good reasons probably to look at these type of institutions as being a financial institution. What is your view? How are lenders assessing this type of business, and what are their key metrics they are looking at?
I'll name a couple and then defer it to Alex to add to that. So in absence of underlying cash flows, you're really looking at the asset and the solvency of the business. And so one of the most critical ratios and relationships there is how much equity is in the business. If I'm lending, then where do I lie in terms of that waterfall? When my principal payment comes up, is there enough equity to potentially pay me back if the business hasn't actually earned enough profit and retained earnings to do so? So that's just one of the critical underlying pieces that always comes up. What is the leverage ratio of the business? How much debt to equity? It can be defined in many different ratios, but how comforted will I be that there is a backstop there and that the business isn't all leveraged through various forms? And that can come through, for example, parent level guarantees if the entity has a parent and a junior structure, or it can come in the form of just leveraging an equity raise that's been done before. The other that I'll mention is again, the ratio of assets. So this advance rate, this collateralization level, for example, if you have a book of 100 receivables, how much am I lending against that? Am I giving you 50 against that? Am I giving you 70? That's critical because I know that I have a buffer, which can be dug into if the portfolio shifts. And this is where risks like FX play so prominently, because if I have a book of 100, and that book of 100, for example, USD, and the currency depreciates rapidly, that book of 100 might become 70. And now if I've provided you a loan of 70, I now have no buffer whatsoever in 1 year's time. And this is why many of you have brought up the FX question, because one angle of this is portfolio default. Have I seen defaults across my receivables book that would reduce that? Or have I seen the devaluation based on FX? So those are just two, but I'll pass it on to Alex as well.
Yeah, just one point on the equity leverage at the company level. I mean, grants also can provide some of this coverage as well. So it doesn't just have to be an equity raise, which at this stage, at a seed or a Series A stage, can be challenging to raise a substantial amount. It may be tranched over time, so it might not be optimized from that standpoint. But also, I mean, these are common instruments, and they do have common advance rates in well-developed markets. Factoring has a specific advance rate. Receivables financing has a specific advance rate. Invoice discounting, purchase order financing, and so forth. The question is, how do those apply to the collateral that we're looking at? And how do you discount, or how do you discount that? There's obviously a lot of use of technology and credit management, credit risk management tools that the pay-go companies are utilizing to understand the customer, the credit history, and so forth, and that plays a significant part in it. And it has over time, so you can understand the non-performing loans potential and these types of elements. But traditional coverage ratios, so to speak, are not necessarily being applied at all if there are not active cash flows that can actually apply. But certainly from an asset coverage ratio standpoint, for instance, how to agree on what makes sense and how that may change over time based on the improvement of the portfolio. So hopefully that helps a bit.
Just a follow-up question. You said that grants can sometimes be used to pay off debt. Isn't that generally kind of frowned upon by both the donor and the lender?
The grant reference was to add to the equity base, so not necessarily to repay the debt per se. So it could be viewed as an equity comparable.
And just to elaborate on that, I think an interesting dynamic that we've seen is one between lenders and companies and attention around portfolio health. And I'm sure many of you will be nodding if you haven't already. This is one of the most challenging topics, is how much can I lend against your portfolio? As a result, how efficient is the debt? Now that challenge comes in expansion, because now if I'm a company, I'm active in Kenya and Tanzania and Uganda, markets that are more known, and now I want to expand to country of choice that's off the map, right? Sierra Leone, for example, to take an extreme example of a lesser developed market, or even a more developed market that's lesser understood, like Senegal. And if I want to do that, that portfolio is even less understood than the portfolio I have in Kenya. And so now if I'm a more commercial lender, I'm probably going to take a riskier view of that portfolio because I don't have any data. And you're lending to people who themselves are very illiquid, they're farmers, etc. So in that instance, I might be trying to raise debts and I might not be able to because I'm expanding. And that is another role we've seen grants play in very importantly, where you're helping established companies that have raised debt to layer on new types of in a sense, equity substitutes so that they can expand into markets they wouldn't be able to otherwise. Dan, you want to add on that? Or?
One of the things we see is like, it's really easy to get really complex about ratios, debt equity ratios, leverage ratios, and all that. And at times that can get you away from actually how a business functions. And some of the simplest metrics around how these businesses function, I think, are their unit economics and how much free cash flow they get from their unit economics. So growth has a way of like confounding all P&Ls, and you look and you say, well, growth is the reason that everything looks kind of funky here. But when you actually strip away growth, I think one of the questions we always ask from a solvency perspective, and we do almost entirely off-balance sheet facilities or facilities where the originator is the servicer of them. So our question is, will they be around? When you start factoring in growth and you start factoring in equity and all that, it gets really complex, but what's really simple is there enough free cash flow on a unit basis to cover the cost of business as usual expenses? So if you were to cut off all future growth, like if you were to say, you know what, we're not going to expand into this new category and we're going to stop spending money on new product development at this moment, would you be able to cover your cost basis in a way that allows you to continue functioning? And that's actually a way simpler thing to get to in our experience. And you can start from that by just looking at it on an on-unit basis, like how much money do you make per unit, what's your cost of getting that unit into the field, what's your cost of servicing that unit, all numbers which are understandable, there's good information about, and then you can see how much excess cash you get off a unit, and then you can see how much that covers your overhead or not, which I think is one of the easier ways to do kind of a bottoms-up build to really understand these business models, which starts with how much cash, which is actually not a well-understood concept, because when you're financing cash, you're not financing the full life of a customer typically. They might have already gotten a deposit. The the provider might have already received a deposit, so you're reducing it by that much, and you have variability across regions, and you might be collateralizing. So I think just starting with like the really what am I buying, and building up from there is usually, we think, the easiest way to do it.
So this gets to a really important point of how to simplify some of these works so that they're more straightforward, understandable, neater, lighter, less expensive to transact. At the same time, a downside of that approach could be that the debt carrying capacity, the debt coverage ratio of the business could be very low, and therefore your debt level that you could potentially argue you could lend to the company would also be low, so it may be suboptimal from a capital structure standpoint. To be seen, right? It applies to different companies differently, but this is one reason why we try to go the extra length. I think what operators say, we need extra debt. How much can we actually deploy?
Andreas, Alex, are the debt providers predisposed to a standard financial covenant package? And to what extent are we seeing more covenant light type of orientations here for those who are participating in the equity side?
Maybe just the broader, to speak to a spectrum of lenders, and then responsibility is one very active. We've interacted with many types of lenders in this space, and to some extent this is an amalgamation of different lenders who have come together somewhat serendipitously because of the type of asset involved. So we've worked with family offices that have never engaged in more commercial approaches. They've been more philanthropic, and now they see their unique value driver is to provide some form of debt. But because they're not traditional lenders, they've never had a book of typical terms before, and they're coming to the table just to see what works. We've seen that structure. We've also seen the very commercial lenders who've never lent in Africa before coming to the market for the first time with very standard, incredibly standard lists of terms that they would expect. For example, debt service coverage ratios, where they want to see 1.3, 1.5 times. Now, if you don't have cash flow or EBITDA, you don't have a DSCR because you have no cash to cover your debt, right? And so they look at these businesses and are scratching their heads saying, but I see so much revenue. And then to Daniel's point earlier, it's a question of, well, is the growth really what's offsetting that? And can I come in more creative ways? And they'll go through the layers of the bureaucracy. And in some cases, they'll change that entire approach to lending just to enter the space. And I think that's really admirable, that they're willing to dip the toe in the water and really start experiencing that. But there's a spectrum with two sides on it, and we've seen everybody in between, including those who are used to lending to MFIs, not solar companies, and want to get more comfortable with how portfolio health looks for solar. And those who are very used to solar but haven't really thought about PAYGO as a whole as a model. So there's a spectrum.
Yeah, just to, at the high level, I mean, we do look at some common metrics, let's say, but those that apply. So a DSCR is not something that we would typically look at. An asset coverage ratio is understanding the collateral, setting a collateralization rate that we believe is agreeable and appropriate. And then alternative forms of security, i.e. in the form of equity or leverage ratios or parent guarantees and the like. And then, of course, metrics on the actual loan book, the portfolio, so non-performing loans. So those types of things that apply to the business.
Hi, this is Sam with PaySolar. So if we look in the off-grid sector, there are two ways in which I think the companies are operating. Some are operating like an utility where they've got these devices around the place, and I think they're carrying them on their books and they're charging for a service. And some are operating as equipment finance business where they're really kind of ring fencing a loan per customer and they're collecting. How do lenders, and as we move up this chain to getting into more structured commercial lending, how do they perceive these two business models? Is there an advantage to being one or the other? And then my second question is, as you grow this business model, especially the one that's operating as an utility, large-scale utilities easily raise hundreds of millions of dollars, and it's kind of normal. It's understood around the world. What does it take for the off-grid sector to get to that point where the assets can be looked at that way and they see the revenue coming in? Yes, it might not last 20 years, but it's going to last 5 years and it's going to generate cash flow. So just a perspective in guiding which way to go and what's more advantageous.
I didn't actually get the entire first question.
So it was just service energy as a service model versus an asset ownership model, basically, and just how do you look at financing one versus the other, and is one attractive or not?
Yeah, I mean, in theory, they're both attractive. I mean, we've seen both models. The second example you gave, I think, was more of a, let's say, centralized rural utility. Is that it? Were they all pay-go distributed small-scale solar home systems that you were referring to?
No, I was just referring to a particular business that has a portfolio of devices maybe spread around the country and charging for them as a service, but then looking at that entity as an utility because they've got infrastructure and they're charging for services, and then how do they get close to be treated like a real utility in terms of creditors and financiers?
Look, I mean, to some degree, it comes down to an understanding of the value and the salvage or recovery value of that asset. So, depending on the lease model or the asset model, we would have to take, I mean, a very sort of careful view of how it's structured. It's difficult to say at sort of a detailed level without, I guess, an actual example, but we would try to understand what the value of that underlying asset is, and if it can actually be marketed or salvaged in any way. If not, then we start to run into some problems.
And maybe just to add to that, I mean, very good question about how we transition to these more commonly understood utility or project finance models. A couple of the big differentiators: one, most project finance comes with a power purchase agreement, right? So fundamentally, you've de-risked the project because you agree to take or pay, you agree to buy all of the power generated. In absence of that, you're relying, call it more a utility model, you're relying on consumers buying the end power, but you're servicing urban areas. You're servicing consumers who often have consistent, very high levels of demand that are quantifiable and well understood, and you're servicing industries that have high demand as well. Whereas when you're going more rural, you're dealing with populations where demand trends aren't quite as well understood, and portfolio health isn't as well understood because their own cash flows are very cyclical. So when you're financing groups of underlying customers who are rural farmers, for example, their income will be often very closely tied to harvests. And so if they don't have cash to repay you, they're not going to repay you. And so I'm just mentioning some of the specific challenges because now if I'm a lender looking at that, I'm trying to understand, can I assess across a whole portfolio of varied, often rural consumers, what their actual energy demand will be, what their ability to repay will be. And if you're a services model, that demand becomes critical. So we've heard, for example, in mini grids, that becomes so important to understand consumption trends. If you're actually owning the asset, when am I going to get my money back? When are you going to repay it? And does that fluctuate, or can it be common across periods like it would be a loan? And until those are better understood, I think lenders will always scratch their heads around questions like, well, what is it, the underlying consumer I'm financing? What is the salvage rate if I actually have a unit in the field and you stop paying? Can I get it, repurpose it, and redeploy it at fairly low cost? And questions related to that. One issue I want to call out that's just really at the core of all this is just defining portfolio health and those metrics. And this is something GOGLA, and I think even this morning, was working on with many of you. It's so critical because now if I'm a DFI or a more commercial lender, and I'm looking at a broader loan of say $50 million into a business, I want to understand the relative capacity of one business versus another to repay me. And I want to understand it as simply as I would if I look at, say, PAR 30, Portfolio at Risk 30, which is a common metric for MFIs, where I can assess across 10 MFIs what their true risk is for their portfolio. And again, I'm not going to necessarily unlock very large-scale capital if every single credit assessment has to be done on a very individualized, non-comparative basis.
Which is where pay-go technologies, some innovative technologies now are playing a really, really interesting and potentially huge role in having lenders and operators understand the customer payment cycles. Yeah, information around credit quality, customer habits, and things of this nature.
Hi, I'm Emma from CDC. Just going back to the first question, do you have a view on what the optimal or the sustainable leverage ratios are for these companies?
I think the question was, do we have a view on what the optimal or sustainable leverage ratios are for the companies? I can tell you just from our perspective, the answer is always it depends, because it's always linked to some analysis where literally what we're doing is understanding what the cash flows are today, what they could be in the future, how those cash flows could potentially cover leverage. And then frankly, if we're borrowing a lot and we've got those principal repayments, it's very unsafe to think that they'll just be rolled over and refinanced. We have to assume that you're going to have to pay the money back. And so if we can't buy into or analyze a projection period with sufficient cash flow at some point to repay those loans, point one, that's challenging, and often you can size debt based on that. When a company is really far away from cash flow, that becomes much riskier, and it's more a question, as Daniel pointed out, of solvency and equity. So if I can't rely on cash flow for a 3-year period to repay my principal, can I at least call on the equity investors in the business to do it themselves? And that's where guarantees come in handy, that's where et cetera. So we're often basing that number, whether it's 60%, 70%, 50% debt, based on the individual business's amount of equity and future cash flows.
It's not a dissimilar exercise from what a project financier would look at from a fixed power generation asset when they're trying to determine the debt service coverage ratio, which also has a lot of variance based on the resource and the technology and the utilization rates and things of this nature. So even with these very mature financing mechanisms and projects, these still vary project to project.
Let me just add one caveat on that. When we're talking off balance sheet, that changes slightly for obvious reasons. And off balance sheet now, we're looking at, what the financing is more an equation of the amount of receivables book that you're financing often. So, it would be quite imprudent, for example, to buy 100% receivables for 100% value and then just stick with it in hopes that not a single one defaults. Whereas typically there's a ratio there where you keep a certain percentage buffer, and that percentage buffer is linked more to the actual portfolio health than to the company itself. With the exception, of course, of the point Daniel raised, which is you want to make sure the company can still be around to service the actual portfolio.
Hi, Jeff Manley from CDC. One issue that I think is really important that hasn't been talked about too much during this conference is accounting treatment, particularly for pay-go companies, where when we've looked at some of the financials, you can see a huge disconnect between the revenues that are reported and the actual cash flows. And sometimes it's hard to tell whether or not they're just sort of being aggressive with the accounting, or whether or not it's what's required by the accounting standards. So just wondering how you've dealt with that issue in transactions that you've worked on, and more generally, what can lenders do to try to bring some sanity and standardization to the accounting treatment for these pay-go contracts?
I mean, we haven't faced this in any sort of a serious way, so I wouldn't really be able to speak to it, actually, to be honest with you.
We can, and we've dealt with this a lot because we often engage very operationally with businesses, and frankly, we're often on the side trying to figure out the accounting treatment, and it's hard. I'm not an accountant, but we often hire some as well, and it's very challenging because you are. You might be reporting on IFRS, but you also have local accounting standards that are pretty critical. You have intercompany relationships that become very important in terms of how you're transferring assets. And you have a lease recognition that, frankly, often correctly recognizes revenue up front, I would argue. And so you can get every opinion you want, and often we have. But fundamentally, I think when you go to the market, we go to lenders, we always have to show a cash story. Because you need to see what is the cash flow, especially if they're decoupled. That's not divorced from the fact that you have a revenue book that's important from an accounting perspective, but that cash flow statement becomes really critical because if you over leverage on the premise of more book revenue, you might end up in a hole later on. And so again, trying to find the rationale for why the business is accounting the way it is, which often is appropriate, I would say, and just understanding as a lender how do I leverage that sufficiently without being overly aggressive. You might be.
Yeah, so I may have misunderstood, but I mean, we've seen quite a few financial advisors providing transfer risk pricing and other studies and analysis on the accounting that validates it to some degree for us, whether that's being paid out of pocket by the company or through grant funding or TA. The studies can be quite expensive, but they're quite important.
Any other questions? We started slightly late. Well, let me take one here and then come over to you.
Hi, I'm Vivek from Symbiotics, and I have a question going back to the issue of portfolio quality standardization. And I guess apologies if we're going to cover this in more detail later in the next few hours, but just generally in the same way that microfinance, a long time ago, standardized portfolio quality health around Part 30, what are some of the ideas floating around amongst investors in the pay-as-you-go solar space to standardize portfolio quality health in the off-grid solar space, considering the different business models?
Well, would you want to speak? I mean, I think part of our personal challenge is that there are a lot of very different views still from the different businesses on some pretty challenging topics. For example, how you extend grace period, right? Because if you've got consumers and they're obviously cyclical, then you need to extend some form of grace. You need to extend some flex around repayment. But how much do you do it, and within what bands? And as a result of that, when do you define a receivable as at risk or not? And we've seen many different definitions there. And frankly, I personally don't know how to decide which is the best. So we've for a long time been hoping for more of a general study done by a neutral body to better kind of categorize that. My understanding is that's what GOGLA and some of its partners are doing. So our hope is that more of those standards can come to light, where the debate can circle around, well, this is how everybody does it without sharing sensitive data necessarily, and is there rationale around aligning so that we as a sector can bring in more capital? And I know many of you in the room have engaged in that topic, and there's more discussion to be had, so I'm not the best one to answer that, I would say.
Do you want,
I would just add, I think it's a good opportunity to engage constituents across the market, including local financial institutions, MFIs, NGOs, government agencies like Financial Sector Deepening, these types of folks who can all come together, because standardization is not going to happen if there's 5 different types of standards.
Well, Daniel, you probably dealt with it.
Yeah, so at Lendable, we spent our first year and a half in the market doing nothing but trying to solve a pretty simple question, which is what is risk and different types of receivables. So we don't only work in pay-as-you-go, we work in other types of asset finance as well. And one of so even before standardization, which I think we're so far away from, I think we are so far away from as an industry. Even before that, I think the core question is a relatively misunderstood question. So people believe that PAR and something like a predictive score are two fundamentally different things. They're not. PAR is a human way of predicting the future. So why do we do things like PAR? We bucket things, we call it something, and that's supposed to have some indication of a future event, right? So PAR 90 is supposed to indicate a higher likelihood of default than PAR 15. We're predicting the future. We're just not very good at it as humans. So we create really simple methodologies for doing that. The simple methodologies aren't as simple as they look. PAR is actually a relatively complex thing to calculate because of things like Andres was saying. You give someone leniency. Suddenly, are they a PAR bucket lower than they used to be, or are they in the same PAR bucket? They had 15 days of leniency. So that complexity, we believe at Lendable, predictive scoring, the highest value isn't necessarily accuracy, although it's much more accurate. The highest value is interpretability. And what I mean by that is you can simplify things down to the question you're trying to answer. So the question we're all trying to answer in this room is, with underlying assets, is how much will be paid per asset, right? That's what we really care about. We don't care about the PAR number, the current PAR number. We want to know, in an ideal world, at the end of that customer's life, how much money did they pay? That's the question we're trying to solve. And the thing about predictive analytics is that's the question you're asking the analytics. So the result you get out of the analytics is a probabilistic score of the likelihood of that event. It's highly interpretable, right? We can say, and we've now seen a few 100,000 customers, we can say, this score, a 900 out of 1,000, let's just make them numbers, indicates a 85% probability that a customer will pay their whole life cycle. It's highly interpretable. If you tell me this customer is PAR 60, I now have to use my human brain, which isn't great at numbers, to say what does PAR 60 mean in terms of likelihood of a future event. So I think really at the end of the day, like simplifying the question we are asking of the data is really important. And the question I think we're all asking of the data is how much money gets paid at the end of a life customer. Then coming up with the metrics that best do that. Predictive metrics, again, are great because they literally predict that exact event if you have enough data, which I don't think a lot of people do. And if you don't do that, then you can do things like PAR metrics, And then really what you're trying to do is you need to correlate it. So you do need someone with data. But I think we've been involved in a few efforts to like do standardization. And I think it's really challenging because the second you get into the tools, the PAR, like PAR is just a tool for predicting the future, everyone has a different operational view on how that should be measured, which is not what we're actually asking. We're asking from a finance point of view, how should PAR be measured? And suddenly you're asking descos to do two different calculations. Their operational calculation, which they should keep doing the way they're doing because it's the best way for them to get on top of customers, versus a finance one, which is a tool for financiers to make a investment decision, which fundamentally like the descos shouldn't care about on a day-to-day basis, only when they're in a fundraising mode. So I really think like we need to get back to like the simplicity of what are we trying to predict, and we need to realize that this is a different metric than an operational PAR metric and not conflate those two discussions.
Thanks. I think we have time for one more question if that's right. So.
One over here.
Thanks. Mike Rosenberg from Alucia. Given the overlap of aid objectives and the work that players in the space are doing, as well as new entrants, have you seen DFI's aid organizations moving from the grant stage to being a guarantor and providing that necessary backstop so that as the business proofs points are being established, those businesses can have the lower cost of capital that would traditionally come later when EBITDA is positive? So stepping in as a guarantor in the early stage.
So just to clarify, are you asking if a company has accelerated straight from that grant phase to larger DFI financing, or whether a guarantee has helped them get this direction faster?
Yeah, so whether someone, whether they've done equity or grant, whether they can sort of skip to that third stage by having aid organizations step in as an early guarantor and taking on the risk when their portfolio health is still being established, as opposed to being able to securitize.
We've seen different examples of grant involvement in different cases. In almost all cases, I think we haven't seen it successfully leapfrog a step, because fundamentally you still need track record, you need time, you need number of consumers served, and you need systems and processes and experience. And often the lenders we see, when they evaluate companies that have been grant funded and haven't had much track record, still evaluate them as a very early stage company. There's an exception there, many exceptions. One exception is if grants come in to finance a larger business. For example, USAID has a program called DIV that's funded a number of the PAYGO players, and DIV has come in at a slightly more advanced phase to finance that sort of growth, and then in a sense they've already had a track record. The grant comes in, and that allows them to potentially build systems and processes, approach more lenders, build a broader base, experiment, use the flexibility to try and establish more proof points. But short of guarantees, which is a whole separate conversation, I think it's quite challenging historically to simply just leapfrog with sources of capital, because so much behind that is also required. That's just our experience.
I mean, we've seen with DFIs through public-private partnerships. GCPF, one of our funds, is a public-private partnership. We've seen the USAID DIB program, which came out several years ago as a response to the needs in the market, all playing really important roles. African Guarantee Fund has provided on a company level fairly small guarantees. I think there are a lot of interesting, useful vehicles out there now than there were 5 years ago, for sure. Specifically to what you're asking in that case, no, not exactly, but in theory.
And maybe the only point we didn't have in the slide as well is guarantee instruments. And just briefly, I've seen in the sector a lot of usage of the word guarantee in a general sense. And I think, and one of the points was raised on the panel, is actually very important to understand how guarantees break down. There are many types of guarantees, and they can be structured in many ways. And for example, when we speak with many of the commercial banks here, they say, I've seen guarantees in the past, they don't work for me, it's not an issue. And yet, they've only seen potentially one offer for one type of potential guarantee, and not a full spectrum. And for example, the difference between first loss and pari passu is considerable. Where if you're the guarantor, you're either asking them to share loss, $1 a dollar, right, a shilling, or you're coming in saying, I'm going to take the first 50% of your loss as a first loss provider, or maybe there's a second loss as well, up to a certain threshold, which is a very different proposition. So even when banks say, I need to see an 80% guarantee, not a 50%, that itself doesn't tell you everything in the full picture. So just to caution you, there are various types of guarantees. They're very useful in different ways with different types of institutions and approaches. It's just not the same thing every time. It's the only caveat I put. So I think we're probably, do we have time for one more, Koen? Or are we out
I think we probably need to wrap it up, but thank you so much, Alex and Andreas.
Absolutely.
And everyone for all the questions in the room as well. We're going to stay in the room, and then we're going to have another presentation now from Dirk from Persistent Energy Capital.